Welcome back to Alpha Max channel. In today's video we will discuss a very important company Senseonics Holdings Inc, which is trading with stock ticker symbol SENS. Its stock price is up by 10x in last 2 months. In today's video, we will unveil some very important aspects related to Senseonics stock. I spent almost 3 days for due diligence of this stock. So, guys, please watch this video completely. Things that I found about this company is worth watching this video, and these facts nobody will tell you. In this video, we will discuss in details Senseonics Holdings and its products, its competitors, its target market, its product comparison with its competitors' products, scope of its new eversense 180 which is under FDA approval, why we should invest or not in this company, how much money we should invest, and what should be our investment time horizon. Now, just before we get started, this is a friendly reminder to please subscribe this channel and leave your thoughts about this video down in comments. Making a video and collecting content take a lot of time. Please watch this video completely. Let's start our video with a short introduction of Senseonics. Senseonics is a medical device company that designs, develops and commercializes glucose monitoring products. Its products include Eversense and Eversense XL, are implantable continuous glucose monitoring (CGM) systems that help people with diabetes to continuously measure their glucose levels from the interstitial fluid below their skin surface using a sensor, transmitter and mobile medical application. Their mobile app is available on both Apple and Android platform. Their Eversense 180 days is under FDA approval, which could be a game-changing as per many investors and one of the hot trend nowadays. Now if you take a look at continuous glucose monitor market, global sales of blood glucose monitoring devices are expected to reach $13 billion by 2023, a CAGR of nearly 11%, led by the rising adoption of continuous glucose monitoring systems, CGMs. There are 34 million diabetics in the United States, with 1.5 million people newly diagnosed each year. Many diabetics are turning to CGMs, which provide real-time monitoring, rather than requiring a finger prick, to ensure their blood sugar is at a healthy level. Companies that sell CGMs can expect both growth and competition in this space. The compound annual growth rate is expected to be roughly 22% through 2027, according to one study. Now take a look at key players. The CGM market is dominated by Abbott Laboratories Incorporated and its smaller rival San Diego, California-based Dexcom Incorporated, but Medtronic plc and Senseonics Holdings Incorporated are also vital competitors in this segment. Abbott's Freestyle Libre system is being used by more than 1.5 million people with diabetes and is the leading CGM system in the world, surpassing CGM pioneer, Dexcom. The company said its diabetes care offerings brought in $3.24 billion in the year 2020, a little bit more than 9.4% of its $34.54 billion in overall sales. Dexcom booked a revenue of around $1.92 billion in same period 2020, while Senseonics revenue is expected to be around $1.8 million for 2020. Now we will discuss Senseonics versus other key players. Just take a look at their product comparison by Mr. Roy Beck in his presentation from ADA meeting. Senseonics Eversense CGM needs to be surgically implanted in a clinic but is approved for use for 90 days in the US and 180 days in Europe, making it the longest lasting of all the sensors powering the CGMs. A few terms from the chart require clarification. For instance, BGM2XD means that Medtronic's Guardian 3 CGM sensor and its competing device from Senseonics need to be calibrated against a blood glucose meter reading 2 times daily. Compare that to Abbott's intermittent scanning CGM device, ISCM, or Dexcom's G6 CGM, that do not require such fingerstick calibration. Most CGMs are also able to alert patients with alarms regarding their glucose levels. Abbott's Libre doesn't currently offer those, but a future version, the Libre 2, will have that option, Beck noted. Dexcom G6 and Abbott Libre have FDA indication for non-adjunctive use, which means that they could support insulin dosing, treatment decisions, based on readings that do not separately need to be confirmed by a blood glucose meter reading. Last year, Senseonics received FDA approval for non-adjunctive use, thereby joining Dexcom's G6 and Abbott's Libre that enjoy the same designation. Medtronic is the only company to not have this labeling for its CGM. Now take a look at sales of these companies. Abbott is clearly dominating CGM market with a sale of $3.24 billion, which is almost double than Dexcom sales of $1.92 billion and thousands times more than Senseonics' estimated sales of $1.8 million only in year 2020. There is general perception in market that Senseonics sales will grow in upcoming years after approval from FDA for their 180-day CGM, and they are comparing Senseonics with Dexcom and thinking that its stock will goes up to moon after FDA approval. And you are also watching too many rockets, along with Senseonics symbol in many YouTubers videos that are promoting penny stocks. But in reality, Senseonics already had an FDA approved ever since 90 days from last 4 years, and they already had ever since 180 days in Europe from last 3 years, but we did not see any growth in sales till date. The difference in their already approved 180 days sensor in Europe and new 180 day that is under FDA approval is remote monitoring. The added value in their European product is that now it has an online monitoring system but nothing else. Their ever since 90 day is already in market and it has 6 times more life than Abbott. If they had already a product that 6 times lasts longer than Abbott 14 days CGM, then why their revenue is not growing? The answer of this question is very simple, because of its downsides that they do not mention in most of their presentations to investors. First downside is the sensor insertion procedure requires an office visit and healing time. It's not a painful experience, numbing agents are used, but it is inconvenient and leaves a small scar. And it has to be repeated every 3 months. Second, the system requires fingerstick calibrations at least twice daily, and the calibrations can only be performed when the glucose is in a steady state. The app generates calibration reminder alerts twice daily regardless of whether a calibration was recently performed. That's annoying. Third, the need to have a transmitter on the skin negates many of the benefits of the implanted sensor. Keeping the transmitter working requires a daily ritual that takes about 10 minutes. You must remove the transmitter from the skin, remove the adhesive from the transmitter, charge it, reapply the adhesive, and use a locator guide on the app to replace it directly over the sensor. Fourth reason is, it is not covered by many insurance companies. Now take a look at its financials, with only estimated $1.8 million in sales and almost $100 million net loss in 2020, and with new 180-day CGM, they are promising to make life better for patients, but it will not make life better for investors. At least not yet. At the most basic level, it's pretty straightforward. Introducing such a new device is expensive. Regulators, doctors, payers, health insurers, and patients have to be convinced of the benefits of adopting and reimbursing the CGM device. This isn't surprising, of course. Investing in the technology, market, sales etc. is front-loaded, revenue is only increasing slowly and still far from levels where the company is anywhere near generating cash. Check out these graphs and their history of cash generated from operations. As a result, it's no surprise they have to rely on the financial markets to keep going. Just take a look at level of debt and shares outstanding. Shares outstanding is increasing day by day. This all doesn't look very promising from an investor point of view. With negative gross margins and roughly $100 million in operational cost a year, that moment is still a couple of years out, at least, making more financing almost inevitable. The following is just a bit of a guess, but assuming 25% gross margins, the company needs at least $400 million in revenues to get to that moment, providing operational costs don't increase any further, which seems unlikely. Quite frankly, expansion will require more S&M, so it might be more like $500 million plus. Now if you take a look at their recent presentation, their project revenue for 2025 is around $150 to $200 million, with a net operating loss of $100 million. They will reach break-even with this growth in almost year 2030 if we assume there will be no increase in expense. This is highly disappointed numbers for an investor. In concluding remarks, I would not recommend this stock to viewers, and if somebody is already holding this share, he should take profit from current pump in price and try to move your investment in quality stocks. This is a 10 to 15 year big picture play. Patience seems to have completely left investors these days. Everyone is chasing the overnight payday. If you have an extra $20,000 to $50,000 and you want to play a blind bet, then this stock is good, otherwise I am extremely sorry. I hope you liked this video and please don't forget to subscribe for more in-depth analysis. Thank you.